When you're managing over $1 billion, every decision has consequences. One wrong call, millions evaporate. One great insight, you change someone's life and your own. I sat in billion-dollar boardrooms, met with many Fortune 500 CEOs, and had my hand on the wheel of a fund that could move markets. And in this video, I want to share the real lessons I learned from managing over $1 billion in the hedge fund industry that you'll never hear in school or from finance influencers online. Lesson number 1, risk management is everything. Early in my career, I got burned by making a decision based on hype instead of research. I made the mistake of watching an interview with the CEO of a company before I did my own investment research. And I learned that CEOs are the best salespeople in the world, and you must do your own research before meeting with them or before watching an interview with them. And I made the cardinal sin of putting way too much of my portfolio in one stock. Now, from a risk management perspective, try to never put more than 5% in one position, meaning try to have at least 20 stocks in your portfolio. And also try to not have more than 20% of your portfolio in a particular sector, like technology stocks or retail stocks or industrial stocks, because they're quite often highly correlated. Also, never invest in a stock that is illiquid, because illiquid stocks own you in a down market and not vice versa. Now, the best investors are not the smartest. They're the most disciplined, and they have a methodology and a refined process. And I provide my clients with many templates that help them not only do thorough due diligence, but also manage risk appropriately. And remember, in the finance industry, when picking stocks, you're paid to say no more than you say yes. You're not just investing capital. You're protecting reputation, retirements, and sometimes lives. I once passed on a deal that could have made us a quick $10 million, and it turned out to be the right call. That restraint, that's what separates a pro from a gambler. And Warren Buffett once said the difference between successful people and really successful people is that really successful people learn to say no to almost everything. Lesson number 2, pattern recognition always beats raw intelligence. Jim Simmons, who founded Renaissance, which is a hedge fund that has an average return of over 60% since the 1980s, said, patterns are there. We just have to find them. Now, without data, you have an opinion and not an investment thesis. Analyze data and find patterns. For example, from a behavioral finance perspective, when certain CEOs sell shares in their company, the stock usually is lower 1 year later and vice versa. And I use this pattern analysis to make money going long and short Activision before Microsoft bought it by analyzing stock sales and purchases by the CEO, Bobby Kotick. Analyzing data before investing makes us unemotional investing as well. And pattern recognition is very helpful when analyzing and forecasting financial statements. Lesson number 3, you must learn to think like an owner and not someone who merely is a tourist and rents stocks. When you start thinking like a founder, not a spreadsheet jockey, you see opportunities others miss. For example, I try to not invest in companies when the founder or founders have left the company. Why? Because founders are long-term focused and they take risks by creating groundbreaking new products. And non-founder CEOs are so short-term focused, they believe the biggest career risk they can make is taking a risk. And this is a good segue to lesson number 4, which is the power of long-term thinking. When Warren Buffett buys a stock, he assumes that the market will be closed for 10 years. That is how long-term focused he is. And that is one reason why he's so successful. Don't focus on the stock path, focus on the destination, and value companies not based on this year's PE, but based on the PE of the company you're analyzing in 5 or 10 years. And this will help you sleep better at night too. And it'll stop you from getting seduced into investing in companies that are cheap for a reason. This will also help you to stop selling stocks you love because they went down. Now, my favorite Buffett quote is the New York Stock Exchange is the only store in the world where investors sell stuff when it goes on sale. Think about that. Now, the greatest gains in stocks comes from long-term conviction. In hedge funds, patience is really underrated. Everybody wants to make money tomorrow. I learned how to make money in over a decade. Lesson number 5, what this means for you. These aren't just hedge fund lessons, they're career and life lessons. Whether you're trying to get your first job in investment banking, break into the hedge fund industry, or become a better investor, these principles give you an unfair edge. And you don't need $1 billion fund to think like somebody who manages one. You just need the right framework. Now, if you want to learn how to think like a top investor and actually break into high finance, even if you didn't go to a target school, have connections, or come from a finance background, we created a free training that breaks down the exact system my students use to land roles at hedge funds, investment banks, and top venture capital firms. Click the link below to check it out.